In this lesson, you're going to learn about how to create a purchase price allocation schedule for a more advanced LBO model as we have right in front of us. Now, this is something that we ignored the first time around with our more basic LBO model, because in that case, we were not analyzing Apple's balance sheet at all. We were just projecting the income statement and cash flow statement, and so it didn't really make sense to look at the creation of goodwill, intangibles, deferred tax liabilities, and other items like that, because we didn't have any to begin with, or at least we were not analyzing any with our LBO model. This time around, we do want to include it, and the logic for why we want to include it is very similar to what we did in our merger model, where we looked at goodwill creation and balance sheet adjustments there. So I'm not going to repeat all the logic here because we've already been over this in detail with the merger model, but it's very similar. And the reason why we need to do this, the reason why we need to create goodwill, intangibles, and other items is because, once again, the price that we pay for a company, the equity purchase price, is often much greater than the company's book value, its shareholders' equity. And to account for that, to account for the fact that if we just subtracted the 43 billion in cash here that you see on the screen, if we just subtracted that from our buyer's balance sheet and then also subtracted the shareholders' equity of 7 billion, well, we have a balance sheet that's out of balance then. And to plug the gap, we need to create goodwill, and in the course of doing so, we look at some other items as well. Because oftentimes the value of PP&E changes in an acquisition, or we revalue the PP&E based on market prices in an acquisition. We create intangibles because oftentimes that's simply part of the purchase premium. It's standard accounting practice to just allocate a certain percentage of the premium to intangibles and then a certain percentage to goodwill. We write down deferred tax liabilities because the buyer in this case may have a different tax treatment from the seller, and then we create new deferred tax liabilities because we're often writing up intangibles and fixed assets like PP&E for book purposes, but we're not writing them up for tax purposes. That in turn creates a situation where the depreciation or amortization we're paying for tax purposes is different from what we're paying on the company's income statement for book reporting purposes. So that's the basic logic of why we have this goodwill creation and these balance sheet adjustments in the first place. So to go back and see how this applies in the context of our LBO model now, we're going to begin by linking in the equity purchase price. Now this is really the starting point for this entire schedule because we need to look at what the PE firm is actually paying for Apple. Even though we don't have a traditional buyer and seller in this case as we would for a merger model, we still do have a buyer. The buyer in this case is the new company being formed by the private equity firm. So it's a shell company with nothing on its balance sheet, nothing like that. So we're not going to bother to look at the balance sheet of the buyer. That wouldn't really make any sense here. But we still need to create these adjustments because we still have a seller in this case, a real seller, a real company, Apple. So we're going to look at this equity purchase price first and base everything on that because we need to establish what kind of premium the PE firm or the shell company is paying for Apple over what its book value suggests. So we have that. Now for the book value, remember that the definition of this is just assets minus liabilities, in other words, shareholders' equity. So let's go down and get the book value from Apple's balance sheet. So I'm going to take the $31 billion number we see for shareholders' equity right there. I'm going to put a negative sign in front of it because we're subtracting this. The other thing we want to do here is also write off the existing goodwill that Apple has. Remember that the reason we're doing this is because we're essentially resetting the goodwill balance entirely on their balance sheet. Now we don't absolutely need to do it this way. If we were not doing this, then our goodwill created would be different, but the effect would be very similar in the end. So it doesn't really matter that we do this, but again, this is standard practice to see in merger models and in these types of schedules, which is why I'm showing you this way of calculating the purchase premium. So let's go down and look at the write-off of existing goodwill, once again pulling from Apple's balance sheet. So we'll take the 207 number for goodwill from right there. So now we can just sum these up. We'll take equity purchase price plus the seller book value, which is a negative here, so we're really subtracting it, plus the write-off of existing goodwill. We get to 181 billion for the total allocable purchase premium. Now we need to look at some of these items for PP&E, intangibles, and the write-down of the DTL and the new deferred tax liability. One other point to make here is that the reason we're adding this write-off of existing goodwill is that if you think about it, if we reduce an item on the asset side in the balance sheet, that means that ultimately we're going to need more goodwill on the asset side to balance everything out. By contrast, if we add something on the asset side, such as PP&E or intangibles, then that means that we need less goodwill to plug the gap. So that's the logic for why we're adding and subtracting these various items. If it's an addition to the asset side, then we subtract it. If it's a reduction on the asset side, then we add it, and vice versa for the liability side of the balance sheet. Now for the write-up of PP&E, if we want to be more precise here, we would call in accountants. In our case, we're just going to assume a 10% PP&E write-up. So for the amount here, we're going to take the 10%, and then once again go down to Apple's balance sheet and pull the PP&E number from there, multiply by the 2.8 billion they have. We also need to decide on a period over which we can depreciate this new amount. Again, to be more precise here, we would call the CFO and ask about the average lifespan of their PP&E. We're just going to say 8 because most PP&E, most capital assets like this typically last for between 5 and 10 years, sometimes up to 20 or 30. Land technically lasts forever, is how you take it into account in accounting terms, but most of the time you see lifespans in this range, 5, 10, 15 years. So now let's subtract this write-up of the PP&E. Now for the intangibles, typically the way we do this, instead of assuming a percentage write-up for intangibles, instead we allocate part of this purchase premium of 181 billion toward intangible assets. In this case, I'm going to go with the same assumption that we used in our merger model, and I'm going to say 20%. Now the allocable purchase price, we want to use this 181 billion number. And then for the write-up amount, we simply take 20% times that 181 billion. So we have 36 billion here. For the amortization period, the standard number here to use is 5 years. Remember that goodwill is not amortized. Goodwill stays the same unless you have an impairment, so it lasts forever. Intangibles, by contrast, are amortized. They lose value over time, and we gradually write them down off the balance sheet. And according to US accounting rules, the standard number that you should use for this is 5 years. So you assume that intangible assets last for an average of 5 years. So we're going to subtract this intangible asset write-up. And we're also going to write down any existing deferred tax liabilities that Apple has. The reason that we're doing this, once again, is that the tax treatment that the buyer has and the tax treatment of Apple, the seller, may be different, in which case their existing deferred tax liabilities may not have too much value post-transaction. So for this number, let's go down to their balance sheet once again and see if we can find it there. We see that actually there's no currently existing item for deferred tax liabilities, nothing under current liabilities. Under long-term liabilities, we do have this item for other long-term liabilities. And if we were to actually go into the filings, we may see that part of that is actually deferred tax liabilities. So in that sense, they may indeed be on Apple's balance sheet. However, they're not pointed out explicitly anywhere. So in this case, I'm just going to say 0 for deferred tax liabilities. It doesn't really make a huge difference, and if you go into the filings, you can see that they actually do have a small amount of deferred tax liabilities on their balance sheet, but once again, in a model like this where we have a $200 billion transaction, a small amount for deferred tax liabilities is not really going to make a difference. We could go back and take this into account if we wanted to, but again, we've already seen how to do that with the merger model, and it barely makes a difference here at all. So I'm just going to say 0 for this one. Now for this new deferred tax liability, remember that what we do here is that for book purposes, we are writing up the value of PP&E and also intangibles, but on the tax version of our balance sheet, the schedule that we actually use to determine how much taxes we pay, we are not writing up these values. And so as a result, the tax schedule and the book schedules are different, which creates a deferred tax liability. It means the amount of income tax we're paying for book purposes and the amount we're paying for tax purposes are going to be different. And so that gives rise to this deferred tax liability. The formula here is simply the intangible asset write-up amount plus the PP&E write-up amount times the tax rate. Now the reason why we're multiplying by the tax rate here is because amortization of intangibles and depreciation of PP&E are both tax deductible, at least on the book version of our income statement. So that's why we're multiplying by the tax rate. We're trying to figure out the tax affected difference that writing these amounts up on the book schedule will make versus not writing them up on the tax schedule. So we have a new DTL of around 10 or 11 billion being created here. So we're going to link in and add this one in as well. And now to calculate the total goodwill being created, we're going to take the purchase premium and then subtract or add all these numbers depending on the signs. I'm just adding them because we've already adjusted for the signs within the numbers themselves. And we see that we have around 155 billion of new goodwill being created here. This is not unusual for a technology company, especially to have such a high portion of the equity purchase price being devoted to goodwill. If we were looking at a manufacturing company or a retail company or anything else with a lot more in the way of hard assets, then the goodwill amount here would still exist, but it would be much lower, and the seller's book value would be much closer to the equity purchase price of the company. The final item I want to add here is one of the differences between this schedule and what we saw with the merger model, which is that in this case we're going to take into account the amortization of capitalized financing fees. Now remember the logic, going back to our previous video on sources and uses, is that financing fees correspond to debt, which lasts 5 years, 10 years, sometimes even more than that. And so we expense advisory fees and legal and miscellaneous fees, but we capitalize financing fees and we amortize them over a time span because the debt is going to be outstanding for a while, and the financing fees associated with that debt represent liabilities that the company is going to have for a number of years. The only problem is that we have not specified in our debt schedule the lifespans, the tenors of each of these different types of debt. Now, if we want to be more precise to create a schedule for this, we would actually do that. We would specify the lifespan for each one, the percent financing fee on each one, and then go through and create a detailed schedule like that, which we do in the even more advanced LBO model in the Yahoo case study in the advanced modeling module. So if you want the details on that, you can look at that one. But in this case, we're just going to go with a relatively simple assumption again because it doesn't really make that much of a difference, and because the amounts we're talking about here, amortizing 49 million or 50 million or something in that range over 5 years, barely makes a difference with a company this large. So in this case, we're just going to go with an amortization period of 5 years and assume that on average the debt that Apple is taking on in this leverage buyout lasts for around 5 years. So with that in place, we are now finished with our goodwill and balance sheet adjustment schedule. Most of what we did here is very similar to what you saw in the merger model. So I did not go into as much detail on all the logic and all the rationale behind these numbers, but if you've already been through that and you've been through this one now, you should have a fairly good idea of how we usually set up these models. Now, it could get even more complicated than this, because what we could do here to make it even more advanced is we could look at the book write-up amounts and then the tax write-up amounts, and then the depreciation amount, the amortization period, the amortization amount for both book and tax purposes. And we could look at how this schedule differs depending on whether we're doing a stock purchase of the company or an asset purchase. I'm not going to get into that level of detail here because it's not going to come up in the context of interviews or even most of the time when you're on the job. If you do want to look at that though, again, go to the even more advanced LBO model in the Yahoo case study in the advanced modeling module, where we go into all that in detail and look at how you actually make all those calculations. But for our purposes for now, for this more advanced LBO model, this schedule is very much appropriate, and it gives us sufficient detail to begin making our balance sheet adjustments and to begin creating a pro forma balance sheet for Apple, which is what we're going to do in the next video.